Good morning and welcome to today's webcast, 2016 Year-End International Tax Update. Before we begin the presentation, I'm going to play a brief housekeeping video.
Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize both how you view our presentation and how you interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. For example, you can click the file folder icon to download the group attendance sheet and a PDF copy of today's slides. You can ask our presenter questions during the webcast by clicking Q&A in the bottom left-hand portion of the icon bar and typing in your question. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. We'll ask polling questions throughout today's presentation. Per the National Association of State Boards of Accountancy Webcast CPE standards, CPE credit will be awarded based on your participation in these polls. To respond to a poll, click the button next to your answer. If you're attending this webcast in a group, in order to receive CPE credit, you must complete our attendance sheet, available in the file folder icon at the bottom of your screen. Please have all group members sign the sheet, and please remit only one sheet per group. Also note, today's session will offer you one CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. CPE credit can be awarded only to participants registered as themselves and is not available to participants who view the on-demand version. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon to open a PDF file you can save to your computer. We'll email a copy of your PDF certificate in 2 weeks if you can't download it today. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Welcome, everyone. Welcome to the 2016 Year-End International Tax Update. This webinar is the second in a three-part series addressing tax issues facing technology, life sciences, and communications companies. Thanks for joining us today. We also hope that you join us next week at the same time to review updates in the state and local taxes that may be of interest to you. My name is Richard Croghan, and I am a tax partner in our San Francisco office. I am the Industry Group Tax Leader for the Technology Group, and I will be your moderator today. Joining me today are three of our international tax partners. First up is Bill Armstrong. Bill is a partner in our International Tax Services Group and is also the Office Tax Leader in our LA office. Next up is Ken Harvey. Ken is a partner also in our International Tax Services Group, and he's based here in the Bay Area. Last but not least is Roy Deaver. Roy also is a partner in our International Tax Services Group and is based in Seattle. Today we'll cover a handful of topics. We'll start off with Bill, who will cover the final Section 385 regulations. For those of you who follow developments, you may have heard or read about this. These regulations address certain intercompany relationships and whether they should be treated as debt or equity. These regulations are over 500 pages, and Bill will try to summarize that in about 15 minutes today. Then Ken will cover some IP migration and inversion issues. We still work with a lot of companies to work through these issues. Ken will provide some overview on the current state of migration strategies. Roy will then provide an overview of common issues that arise when preparing returns or when going through due diligence. Roy will also provide a brief overview of what we might expect under the Trump administration. Now, as was mentioned in the introduction, participants will need to complete 3 out of the 4 polling questions in order to receive CPE. Our first question is an easy one. So we wanted to get a sense of the companies that are represented today. So how many participants out there, how many related foreign entities do you have? Do you have none because you're just listening in? Do you have one? Do you have a few, but it's still pretty simple? Or do you have a lot? And these are big, compelling issues for you. Remember, once you click the button, also don't forget to hit submit. It's the black square in the bottom right. Make sure you hit that so that it's registered and then you get the appropriate credit. We'll leave it open for about 10 more seconds, so give everyone a chance to submit their answer. All right, gonna move on and see the results. So about a third had none. Interesting. So I don't know if those are maybe consultants or, but 2/3 have some foreign subsidiaries. So I kind of, that is probably in line with a lot of the companies that we work with. Most do have some sort of foreign presence. So that's good. So with that, I'm going to turn it over to Bill to start our technical part of the presentation, and he's going over the Section 385 regulations. Bill.
Thank you, Rich. This is Bill Armstrong, and I'll start by saying I'm not going to be able to cover 500 plus pages in 15 minutes, but I will do my best to summarize some key components, especially for what I'll call the middle market. And maybe I'll start by just giving a background on 385. 385 deals with the definitions of debt, and the statutory provisions are actually pretty light. In Congress intended for Treasury to be able to expand upon those in the regulations. And last April, the Treasury IRS did exactly that, set a very expansive set of proposed regulations that covered, I'll say, just about every transaction that's out there. And there was a significant amount of commentary that came back on that, and as a result, final regulations were issued in October of this year, and those final regulations are greatly and significantly narrowed in scope. So real quick, big picture, what do these 385 regs do? They basically have two broad objectives. One is to require documentation. That'd be contemporaneous documentation on certain related party debt instruments. And we'll go through some of the restrictions, but keep this in mind. They have to be issued by a domestic corporation as a prerequisite to the treatment of such an instrument as debt. Otherwise, such instruments are treated as equity and subject to a rebuttable presumption that they're debt or equity. So again, it's U.S. issuers, generally to a foreign related party. The second part of the regulations look for targeted intercompany leveraging transactions, and this is under the 385-3 regulations. And this looks to have the treatment of stock of certain debt instruments issued by the domestic corporation to a related party by way or in connection with a distribution or an acquisition. And you're going to see these normally as structured transactions as part of an acquisition, or structured transactions as part of a repatriation or expatriation of cash from the U.S., generally to a foreign parent. But I will warn everybody that if you read these close enough, these could actually apply to payments out of the U.S. to a foreign subsidiary as well, or the instruments between a U.S. parent and its foreign subsidiary, depending on your facts. Our specific focus today, though, is going to be on what I'll call just the kind of the low-level blocking and tackling items. It's going to be on the documentation, and then how limited the short-term debt exception is. And so there's a lot of discussion around the short-term debt exception. So we're going to just spend a minute, and I'm going to tell you what that exception is and just how limited it really is to apply. A couple of caveats. First, there are many open questions. I have open in quotes. I'm not sure from the political landscape that Treasury is necessarily super interested in resolving any of these anytime soon, and we'll talk about that as far as why that could be the case. But these rules are written to apply to all of Title 26, so it's all the code and regs, all the code. Then 385 specifically excludes or provides exceptions or carve-outs for certain transactions. So the result is these rules apply to you unless there's a specific carve-out, and there are some areas in the code where you have specific debt rules that are not specifically carved out under 385, and it creates a bit of a conflict. So you will likely see some litigation in that area or further development in that area if nothing changes. Now, when we talk about things changing, I will point out that there's quite a bit of, and I'm not a political guy, but there's quite a bit of chatter around both the soon-to-be administration and also the Congress that potentially you could have some of these adjusted, removed, or modified. And I do get the question every once in a while on how that can happen. It's not as simple as what you read in the press that President-elect Trump can come in and just cancel everything. There are some rules that are in play, and it's not necessarily an automated process. So let's get right to it then. 385 regulations generally apply to debt instruments. So what is an instrument that this is going to apply to? So the first thing you need to have is a covered member. Currently, a covered member is defined as a domestic corporation or a disregarded entity of a domestic corporation. It's a covered member. I will highlight that this is a pretty significant change from the original proposed regulations, but these final regulations still reserve the right or the ability for Treasury to go back and further expand the definition of a covered member. And that could be, for example, foreign issuers of debt. It's got to be held within the expanded group. Expanded group is generally defined to include all corporations connected to a common parent that owns directly or indirectly at least 80% of such a corporation. There's some special carve-out rules about consolidated companies under the U.S. rules. We won't go through those, but just understand that issuers of a consolidated group are generally treated as a single member. So intercompany consolidated U.S. instruments are not covered by these. And then there are some specific carve-outs, and this is what I was talking about before. S-corps, mutual funds, REITs, and so on are generally not going to be subject to these. So let's go to the heart of it, documentation rules. So I mentioned that one of the major thrusts of the regulations was to bring into line documentation and the documentation requirements. I think all too often what happens is we end up with intercompany transactions that get booked in a GL that really are designated as debt or equity merely by the account they hit and not necessarily the intent of the parties or how they actually conduct themselves. So what I want to do is just very quickly highlight what the debt items are or the documentation items are on the debt. And then I'm going to highlight one very important aspect of this here at the end. So the first thing is you have to document the issuer's unconditional obligation to pay a sum. And that means it's unconditional, legally binding obligation to pay. It's got to meet the normal terms of fixed and determinable, and it can be on demand or at one or more fixed dates if there's a series of payments. So it looks like a normal debt instrument. The holder's right as a creditor. So as a creditor, you have to have a right to enforce the obligation. Typically includes the right to cause or trigger default or acceleration and cause, in the case of a failure to pay. And again, that's a key component there. You have to have normal creditor rights. You can't be subordinated to equity holders. Generally, debt holders don't subordinate their debt to the equity holders. There are provisions applicable to non-recourse obligations, and most of these need to be documented in written documents or by reference to local law. The final piece here, and this is where you have the issuer's ability to repay the obligation, and this is where I think a lot of companies kind of fall short, and that is at the date of the issuance, it's got to be supportable debt. There has to be a reasonable expectation it's going to be paid. That can take into account all the relevant circumstances. Certain provisions, again, are applicable to non-recourse obligations that are a little bit more stringent. There is some requirements for annual credit analysis depending on the frequency of your issuance. And in those cases, you could end up with additional documentation requirements if you have material events that affect the credit worthiness of the issuer. Finally, and this is the part that I do want to focus on a little bit more, or at least make it a little bit more pointed, and that is you have to take a look at the actions of both of the parties. The written documentation of payments with respect to interest and principal needs to be enforced and enforceable. And therefore, you need to show evidence of the holder exercising their rights under the agreement in the event of default. And I think this could be a hurdle for some companies where they will put debt into place with good intentions or the intentions of documenting their compliance, but ultimately that's not going to be enough. Ultimately, you're going to have to show that you're executing under the terms of the agreement. Now, that doesn't mean that you have to, on every default, you have to foreclose on the company, but it does demonstrate that you have to show the economic analysis as to why you are doing that or not doing that, and how you, as a third party, would execute under the terms of the note. That kind of brings us in then what happens as far as the debt recast under the general rule. So again, under the general rule, there are certain prohibited transactions that this is looking to target. Basically, if the instrument, I won't call it a debt instrument, but if the instrument is in conjunction with a distribution, an exchange of the expanded affiliated group stock, or other than an exempt exchange, so certain exempt exchanges will not fall into this, then is pursuant to a plan, the shareholder member of the issuer's expanded group needs to address whether or not this prohibited transaction then will automatically create an equity position as opposed to a debt position. Now, there is a further clarification of covered debt instruments, specifically in the form of exclusions. And some of these are going to be key dates for you, so these are things to keep note of. Exclusions from debt instruments will include any debt instrument issued before April 5th, 2016, which is the date of the proposed regulations. I will caveat that with saying that there are rules on modification of existing debt instruments where if you had a debt instrument before April 5th and you modify it, you could end up with a new debt instrument. And then there are certain other statutory and regulatory exclusions where debt is otherwise managed somewhere else. So, for example, debt for insurance companies. Let's quickly talk about qualified short-term debt instruments. This got a little bit of play in the idea that you could have short-term, quote-unquote, short-term borrowings and be exempt under this, but short-term is specifically defined under these regs. And there are two tests. The tests are fairly mechanical and mathematical. I'll just tell you that the tests are a specified current asset test or a 270-day test, noting that both of these require that the debt really looks like short-term. 270 days is basically 9 months. So these are not short-term in the sense that it's 3 to 5 years, but these are seen to be several months in length and not necessarily several years in length. There's also ordinary course loans that you could fall under that's for ordinary course of a trade or business that are not monetary in nature. In other words, you're not supplying money. But in those cases, it needs to be interest-free, and you need to take into consideration OID rules for that. And the interest-free period needs to be less than 120 days. Again, that's a pretty narrow definition of short-term debt. I will also say that there are a lot of companies will have what they have is cash pools, and cash pools or qualified cash pool headers can also fall under this, but it's not as simple as having a treasury. So there's some rules specific to the treasury has to be within a separate QBU or qualified business unit, and therefore companies that use a central holding company that does more than just treasury functions could run into some problems with that. If you have centralized treasury, centralized financing, or if you use notional principal treasury centers, you really have to dot the I's and cross the T's on this. Otherwise, you could end up falling into these regulations with it being equity distributions and contribution effect. So the one slide that I didn't shorten up because I want to make sure everybody can kind of walk away with this, and that has to do with the effective dates. And I want to kind of highlight this because one of the questions that comes up is how can some of this stuff be modified on or around January 20th if the President-elect Trump so chooses to do that and do it in a way that's by executive decree as opposed to by working through Congress. And so the first thing is the general provisions, the documentation, the consolidated group rules, all of that take place for tax years ending on or after 90 days after the date of the publication of these regs. So if you remember back to slide 1, these came in on October 13th. So you're looking somewhere around mid-January. That's mid-January in 2017. There is a delayed implementation for the documentation, which is January 1st, 2018. And the delayed implementation is actually one of the tools that could potentially push these out, depending on when things occur. So, and again, I'm not necessarily a political science guy, but my understanding is you could delay these by executive order by delaying the implementation date until something could be figured out. And it turns out that's nothing new. That happens in all areas of regulation with multiple agencies, and it happens generally at the change of a president. So that's not necessarily new or anything like that. There are some rules, though, if you go out further, that potentially you could need to work through Congress to adjust some of these items. So those are kind of the highlights there. So I guess the final thing really is what are the big things to kind of take away from? So the first thing is that the regulations are significantly limited compared to the proposed regulations. The proposed regulations kind of covered everybody. These regulations only apply to debt instruments issued by members of an expanded group that are domestic corporations for federal tax purposes. So it's not the catch-all for everybody. It's just limited to U.S. issuers. And so you would be, if you have a foreign parent lending money to the U.S., or if you have a foreign subsidiary lending money to the U.S., those are the two areas that you could potentially have an issue here. I will say one more time, though, that the regulations do fully reserve on its application to debt instruments issued by foreign corporations. And although there's a lot of commentary that these rules are pretty daunting for U.S. companies, I can tell you if it applies to foreign issuers as well, where your foreign subsidiaries' debt would be subject to these rules, it would be a pretty significant tax landscape change for taxpayers. The final thing is this used to apply to all debt if you had more than $50 million of debt, and now it just applies to debt instruments issued that are in excess of the $50 million limit. And we're not going to go through these rules, but there are specific rules on how you measure the debt depending on the financial statement group. You do not look at the worldwide consolidated financials to determine this. It's done country by country and entity by entity, and then there's some grouping rules. So with that.
All right, Bill, thanks. We'll move to our second polling question. Remember to need to complete and submit these so that you get CP credit. But with that, there are some Q&A questions coming in. A reminder to all participants, if you have some questions, feel free to use the Q&A functionality on the presentation. But Bill, one participant asked if they have an existing intercompany payable, are they at risk if they don't get all this documentation in place?
So if it's a pre-existing intercompany, and this is where it gets a little tricky. If it's a pre-existing intercompany that's an undocumented, unstructured intercompany, and it existed prior to the proposed reg issuance, then there is the ability to grandfather it without having to necessarily pick up all these rules. Having said that, undocumented intercompany transactions generally, as we all know, end up with debits and credits running through, which begin to look like modifications. There's some specific modification rules, and if you end up quote unquote with a modified instrument, then all of a sudden you could end up under these rules on a pre-existing account. I'll also just say that even if you had documented intercompany and you do things like change the obligor or you change the material terms of the instrument, you could also end up triggering these rules on a pre-existing debt instrument.
Okay. So remember, everyone, to answer the polling question: how will these regulations affect your company? From it won't, or you expect the documentation to be burdensome. So, Bill, one other question, because I really like the question. Which documentation do you think is going to be more burdensome, this documentation or transfer pricing documentation?
Well, that's another excellent question, and unfortunately, it's got an answer of it depends. If you have transfer pricing that's a single transaction group between just two companies, then you end up with a pretty straightforward transfer pricing study that you're going to undertake. And I don't think that's any different than these 385 regs. If you have a single intercompany and it's easy enough to isolate and structure, I think you could easily manage that like a simple transfer pricing study. On the other hand, if you're a multinational with a lot of transaction groups, with a lot of countries involved, transfer pricing becomes a pretty big burden, and I think this will fall into the same category. The easiest example, if you're a multinational company and you are running a treasury center out of a foreign country, you potentially, you're going to have a very complex time navigating the 385 rules.
All right, that's great. Thanks, Bill. Moving on, so the results looks like about a third, probably similar to that there's no related foreign entity, so these regs aren't going to be that burdensome. A bunch of people, almost half, are still trying to figure it out. Welcome to the club. We're all working through it. So hope you found that insightful. So we're going to move on to our next topic. I'm going to turn it over to Ken to talk about IP migration and migration strategies. Ken.
Thanks, Rich. And like Bill, I'll try to provide some non-political commentary, which is difficult these days. So what's the status of IP migration, and maybe what is IP migration might be a question some people are asking. And I'll go and ask a third question, what is IP? Intellectual or intangible property, it isn't necessarily just a patent or something you register in Washington, D.C., because a patent may literally have no value. Really, in a business and tax context, IP is the intangible business asset that remains when all of the routine functions are accounted for and their return has been computed. And if you're a company that's very profitable, like but a lot of tech companies, you've got an operating profit of greater than 8% or so, you probably have some IP. And types of IP include, classic intellectual property of what the type that Google or Pfizer might have. But it would also include marketing intangibles like Nike, which is really a giant marketing organization, or a combination of intellectual and marketing intangibles such as Apple so obviously has. So management of the IP is one of the most significant factors that drives the effective tax rate of what I would call, sort of a West Coast intangible based company. And the placement of intangibles related to foreign operations outside the U.S. has been one of the drivers of the tax rates of these companies. To cite a famous example, the tax rate of a company based in California, if it theoretically had all of its sales in California, would be something like 38, 39, 40%. As the papers reported recently, Apple had at one point a tax rate on its European sales of 1/100th of 1%. Now that's an anomalous result, but even if Apple had paid 12.5% on all of its European profits, that's a lot lower than the 39% or so they would have paid if they'd kept all their profit in the U.S. And because of the way the U.S. tax system works, it's a worldwide basis, Subpart F, etc., U.S. groups need to thoughtfully manage their IP in order to obtain a reasonable, favorable result with respect to their effective tax rate, especially as compared to their competitors, both in the U.S. and worldwide. So assuming a company wants to move IP offshore, or some of it, or some economic value, they got to decide what to move and how. Intangibles can be divided up based on product line or geography. Generally, we would say, and the IRS would agree probably, that some sort of all substantial rights transfer has to occur. This can occur via a license of the existing intangibles, followed by a cost-sharing agreement under the 1.482-3 regs, even though those are theoretically invalid, or a simple sale of the IP. Compensation can be via royalty or a lump sum buy-in. All of these issues create significant transfer pricing questions, which of course is a topic of great interest of the IRS and the Treasury Department. And in order to exploit the intangibles offshore, they have to be attributed to a non-U.S. location. It's a common misconception, especially if one reads the papers, that one can simply move some IP offshore and then go home and have no tax in the U.S. And of course, it doesn't work that way. Now, new slide. So when does IP migration make sense? Generally, as discussed, a company should have some IP that is worth something greater than the sum of the parts of the company itself. The IP has to be accessible to a tax jurisdiction where they can earn a lower tax rate or pay a lower tax rate than in the U.S. The company has to, maybe not in the short run, but in the long run, live with an international supply chain that involves people, enhancement functions, other things that are offshore. And the company has to have the wherewithal to defend its setup from the inevitable attacks by tax authorities in the U.S. and elsewhere who are, of course, trying to get their share, or we might think more than their fair share, of tax on the profits of the company. And finally, in order to achieve an effective tax rate benefit, a U.S. multinational under U.S. GAAP rules needs to assert under APP 23 that the earnings offshore on which it paid a lower tax rate are indefinitely or permanently reinvested offshore. And again, companies play, I don't want to say games with that, but a company that doesn't want its tax rate to be too low, such as some famous companies in the Valley, may assert APP 23 on part of their earnings, but not assert it on others, and accrue U.S. tax even though tax is not actually being paid. So there's been a lot of talk about IP stuff in the papers recently, and those of us who follow the news know that something called BEPS is out there. BEPS is something that the OECD started in response to the European Union deciding that U.S. multinationals particularly weren't paying enough tax in Europe, and in particularly the high tax countries in Europe. So they went after a lot of U.S. multinationals and some European multinationals, including Apple, and the European Commission, which is the attack dog of the European Union, recently ruled that Ireland, rather than Apple, needs to pay almost $14 billion in back taxes. And of course, the government of Ireland doesn't like this any more than Apple does. But it created a sense of concern among a lot of multinationals in the tax community that whatever agreements one has with a government, even though they are negotiated presumably in good faith, may not be worth the paper they're written on if some supranational organization can come along and just charge tax and tell the company to pay up. Now, this is being appealed. I don't think Apple's paid a dime, as far as I know, but it adds a lot of uncertainty. But I think it's important to note this, and that is that we're talking about intangibles that the U.S. government believes are already outside the U.S. tax net and not subject to the 40% U.S. tax rates unless Subpart F or some other issue comes up. This is a squabble among the European governments themselves, all of whom actually have lower tax rates than the U.S. So it doesn't necessarily mean that it changes anything from the perspective of a U.S. company trying to manage its intangibles and trying to have an effective tax rate that isn't demonstrably higher than its competitors. So with respect to that, and I think Roy's going to talk about Mr. Trump and his proposed changes. I don't think anything's changed with regard to intangible planning for U.S. multinationals. Whether the tax rate in the U.S. is 15% or 35%, there is still going to be a trend to integrate international operations and have processes outside the U.S. which will from which the company may derive benefits. And in that case, the local jurisdictions are going to be looking to collect tax. If a company maintains all of its IP in the U.S., it will be probably more and more difficult to simply say that all of our operations outside the U.S. are not value added and shouldn't pay much tax. Whereas if a company manages its IP effectively, there will be a lot of IP outside the U.S. to put in the proper jurisdictions and make, if not everyone happy, at least put a reasonable face on the operations of the multinational. Now, I wanted to talk for a few minutes about inversions, which is another sort of term of art that one hears a lot about. I think the word inversion was first made up by a politician who wanted to make something sound bad. But really, an inversion is simply the acquisition by a foreign company of a U.S. company. It happens all the time, not least because the U.S. has such a high tax rate. Sometimes a U.S. company is worth more to a foreign buyer than it is to a U.S. buyer, simply because the rate of return on an after-tax basis will be higher if the earnings are earned by someone who has a lower tax rate. For that reason, a lot of companies have inverted either by being acquired by foreign acquirers or intentionally and quite honestly for tax purposes. And under Section 7874, a rule that's been in place for at least 12 or 13 years, if a U.S. company is acquired by a foreign company and the foreign acquirer shareholders own less than 20% or less of the combined foreign company, then such an inversion is simply ignored for U.S. tax purposes. And I call that a failed inversion, even though sometimes people do that on purpose. The reason a company might do a failed inversion would be if you're a U.S. public issuer, you may decide that it is easier to issue as a foreign company and file under the reduced GAAP disclosure requirements of a foreign issuer in the U.S., even though the top company is then still treated as a U.S. company for tax purposes. Now, that would be one thing, but some companies fall into a failed inversion disastrously and inadvertently. And that's probably one thing to watch out for. And the purpose of my discussion here today isn't really to do a guide to doing inversions, but it's to basically say people don't do inversions every day. So we need to be very careful about how they happen and make sure that inadvertent results don't occur. Here's an example. If a small U.S. company is acquired by a larger foreign acquisition company, the first thing you would think is, well, that's not an inversion because you've got a simple acquisition. Not only that, it might be a cash acquisition. But what frequently happens is that in the terms of the deal, you've got some executives and maybe some previous owners who still have stock or want an interest in the future of the company. And they may be able to swap their shares out on a taxable or non-taxable basis for shares of the acquiring company. Under the recent regulations from April, under what is called the cash box rule, if a foreign acquirer forms an acquisition company, puts cash in it, and is considered a passive asset company and doesn't have an active trade or business in that company, they then acquire the U.S. company with cash or with stock, and over 5% or more of the former U.S. owners are given shares or acquire shares in this foreign company. All of the foreign company ownership is ignored, so that 80% test that we discussed earlier is met and actually it becomes 100%. And that foreign acquisition company, which the innocent foreign buyer thought was going to be a Cayman company or a UK company or something else, becomes a U.S. company for income tax purposes. And that would be not a good result probably for anyone. The IRS, of course, and Treasury has been trying to limit the use of inversions in egregious cases and has continued to write regulations to clamp down on these rules. The most recent were in April. The cash box rule I just mentioned was part of that. And also I should mention that Bill's previous discussion about Section 385 was really targeted for prevention of inversions, because what people would normally want to do from a tax perspective when acquiring a U.S. company would be to stuff debt into it and pull out as much of the earnings as possible, of the operating profit as possible, in the form of interest payments on debt. And hence, the 7874 regulations, including the cash box rule, and the 385 regulations were actually issued together in the same press release by Treasury under the rubric of, we're doing what we can to stop inversions. I personally think it will be interesting to see what Mr. Trump's administration does about these regulations, because given his sort of economic nationalism, I'm not sure that this type of thing is necessarily incompatible with his stated preference to keep American companies in America and American jobs here. But we'll see what happens with that. The bottom line on inversions, though, is anytime you have a restructuring, including, I should add, an internal restructuring, you may fall afoul of these regulations without intending to. So it's a big trap for the unwary. And I think that's all I have.
All right.
Rich?
Thanks, Ken. Thanks. All right. So this brings us to our third polling question. Where is your company at with respect to a fully envisioned or implemented worldwide structure? One's not applicable. We're purely domestic. We have an IC disc, which we didn't really talk about, but that's a U.S. benefit for exporters. All right, then you put your toe in the water and migrated some IP. You have some operations offshore, or you have fully optimized your tax rate. While we're waiting for the participants to answer and submit, Ken, one question came in that I thought was a quick question that you might be able to respond to. What countries do you most often see companies migrate IP to?
Okay, so that's an excellent question, because I think it speaks to the fact that step one of any IP strategy, again, if we're looking just from a tax perspective, not from an operational perspective, is moving some value, some economic rights, some portion of a company's IP outside the U.S. And it may be that a company starts to do that before they have the operational infrastructure to really exploit that IP outside the U.S. So it's very common for companies to put IP in Cayman as kind of Cayman Islands or Bermuda or some sort of tax haven as a holding place. Now, my belief is that under the new BEPS process and a lot of the tax crackdowns, in the long run, having IP in places like Cayman is not going to be sustainable. But it is still probably going to be a place people will move from the U.S. to Cayman as a placeholder until the infrastructure is set up. Once the infrastructure is in place, depending on how things settle in tax reform around the world, you may have some surprising answers. The UK, for example, has a patent box regime and also has at least threatened the EU with going down to a 10% tax rate. That's pretty good. So if I have a UK company and I buy some IP from my related party and I get to amortize that IP over 15 years and I get a 10% tax rate on what's left over, that's sort of a tax haven right there. And of course, you could do the same thing in Ireland, which already has a 12.5% tax rate. And one thing we know for sure is that the Irish tax rate's not going to change. So you've got Ireland, you've got the UK. Again, consistent with supply chains, I think that'll be more important going forward. If we've got a company that's doing business in Asia, Singapore and Hong Kong are good places to think about, Singapore especially, because it's probably got a more consistent sort of trading company attitude in terms of the government. Sorry for the long-winded answer. Hope that answers the question.
No, that was helpful and insightful. Thank you. All right, just 10 more seconds to submit your answer. And then we'll close this out. Remember, hit the submit button. So here we go. All right, so 2/3 of you thought it was not applicable. So that's interesting. So, and also only 3% have fully optimized their worldwide tax organization. So a lot of people in between, and lots of opportunities there. With that, I'm going to turn it over to Roy and talk about some of the common issues that we see both in the compliance and in due diligence.
Thanks, Rich. So as Rich mentioned, there are a lot of kind of common issues that we are seeing, not only in looking at compliance, but ones that we're also starting to spot when we're performing due diligence on companies, whether that is due diligence from the buy side or helping somebody getting prepared to sell their company and getting them prepared in the diligence process. There's a few, again, kind of mostly seeing them in both cases. The first one that always seems to be an issue is transfer pricing. A lot of it is because it is something that is more subjective and not necessarily rule or fact-based. While there are transfer pricing rules and regulations, how those get implemented and how a company implements its transfer pricing and determines the pricing on intercompany transactions can be different from company to company. What we are seeing, though, is that there are many companies that tend to blow it off. Either there's no analysis that's been done as to what that pricing should be, there's no documentation that supports their methodology, and in cases we're seeing that there's not any type of intercompany agreements. And we think kind of at a minimum that's what, that a company should have intercompany agreements in place to help support the positions that they're taking, document who owns any resulting intellectual property, as we learned from Ken, that can be very important, define what each entity is doing and how they're being compensated for that and when they're being compensated for that. And from there, again, one of the issues that we see quite often is that not the entries aren't always being made and or being funded. So that it's very important that those transfer pricing amounts get booked on in the general ledger, but then also that the payments are made pursuant to the terms of the intercompany agreement. One of the other areas that we see quite a bit is debt versus equity, and Bill went through kind of the 385 regulations, so we now have that to be concerned about. However, there's still quite a few, as he noted, that fall outside of the scope of those rules. Main one being cross-border loans from the U.S. to a foreign subsidiary. As Bill noted, those are currently reserved. There's no rules on documentation or other rules with respect to that. But what we're left with is kind of the case law to determine whether an item is debt or equity. So in order to support the debt treatment, as he said, that there needs to make sure that we have all the indicia of debt, that there's an agreement in place, an interest rate that's been set, a payment schedule, and so on and so forth. A lot of times we see kind of open accounts or intercompany accounts that aren't being settled, or it's part of the transfer pricing where they're being booked but not funded. And when there's little or no capital in the entity, that really becomes a risk that amount, those amounts could be recharacterized as equity rather than as debt, resulting in a potential loss of the deduction on one end. But then when those amounts are paid, rather than that being kind of a non-taxable transaction, that those could be viewed as dividend payments. So those are always an important thing to make sure that that there's some documentation that's being done, even though it may not necessarily be the Section 385 documentation that's required, but that the company has that in place. In terms of tax reporting and in terms of and taxable income, items such as Subpart F and investment in U.S. property under Section 956 are always a concern. As these amounts can result in some taxable income inclusions of the company, we always look to see what is the activity of those foreign entities, the controlled foreign corporations, to determine whether or not any of its income should be included in the U.S. return. Again, kind of especially with regard to the investment in U.S. property and back to the kind of the intercompany account item, and transfer pricing is, that's where we're seeing kind of some of the issues. If a U.S. company isn't fully funding its transfer pricing payment to its foreign subsidiary, which is a controlled foreign corporation, and that account is left outstanding for a period of time and over a quarter end, that now that controlled foreign corporation has U.S. property, which is the obligation of a U.S. person, and that can result in an income inclusion under Section 956. So again, trying to not reiterate or repeat the same thing, but it's crucial within the transfer pricing and the intercompany accounts that all of that it's all interrelated in terms of how this all gets reported, how the IRS looks at it, and again how service providers are going to look at it to the extent that your company is undergoing a transaction either as a buyer or a seller, and making sure that those amounts are properly documented and reported. And then additionally, kind of under the reporting, the foreign bank account reporting and related party disclosures, the big thing there is making sure that the right forms have been filed and are they substantially complete. So the IRS came out with some guidelines about a year ago or so for what substantially complete is, especially with respect to Form 5471. So in a lot of cases, when we're looking at these, there's some missing information. And to the extent that that information is critical, it can result in the form not being considered substantially complete, which means it's not timely filed. And for every such instance, there's a potential $10,000 penalty per form per year for those missing forms, or at least ones that aren't considered timely filed. And, those penalties can add up pretty quickly if this has been something that's been a persistent issue with the company over a number of years and or, kind of across a number of foreign entities. So right now there's currently a voluntary disclosure program that's available that allows for these to be fixed on a no penalty basis. However, time is of the essence of making sure that that gets done. While the IRS and the Treasury Department haven't set a deadline for that voluntary disclosure as to when it's going to end, it could end at any point in time. So making sure that those get done and taking advantage of that to kind of clear out any past sins is always going to be, needs to be done sooner rather than later. On the permanent establishment piece, or kind of whether a company has a taxable presence in another country, again, that's more on the diligence side than on the compliance side. But, in looking at that, a lot of cases, companies may not know that they have a taxable presence in that country. If they're sending people or property there, you have to look to whether there's a tax treaty with that country, whether you qualify under the tax treaty with that country, and then whether your activities are giving rise to that. And if there is no treaty, then you're just subject to that country's domestic tax laws as to what, when they say that they have a taxable presence in their country. Plus, the other thing, too, is to the extent that you do have a permanent establishment there, you may be denied some of those deductions associated with that. To the extent that you're not making certain U.S. tax elections with respect to that potential branch that you have in the foreign country, you may lose some of your U.S. tax deductions. I mean, we had a situation once on diligence where we found an entity had a branch in a country that it didn't know was a branch. Most of its deductions were related to people who were related or who were performing work there, and as a result, almost their entire net operating loss carry forward was at risk because they didn't make a dual consolidated loss election with respect to that branch, and as a result, those deductions would have been denied. So again, it's important to understand that if you're moving people around, that whether or not that's going to create a taxable presence for you. So that, again, under the employment mobility, it isn't just necessarily the payroll taxes that can be an issue, but it's also whether the activity of the people in the foreign country are creating that taxable presence for the company. And then the last one is just, kind of indirect taxes, so VAT, GST, or consumption tax, or whatever the foreign countries tend to call their tax. It becomes an issue of whether or not there's a requirement to collect, withhold, and remit these taxes to the foreign government. Us being U.S. people, there's sometimes a misunderstanding or ignorance of how these rules apply, when they apply, and it's just making sure that, companies are looking at whether or not they do apply and doing that appropriately. So just real quick on the potential corporate tax changes that we could be seeing. So with the new Congress and administration coming in January and both of these branches of government being controlled by the same party, it's now probably fairly likely that we're going to see some forthcoming tax reform that we've been hearing about for a number of years. On the corporate side, probably the main piece that we're going to see is a reduction in the tax rate. What that reduction is and what the final rate is going to be. That's to be determined. The president-elect has his thoughts on what that is. Congress, the GOP plan has its thoughts. A lot of it's going to be, based on whether they're trying to make that revenue neutral or not revenue neutral, as to how far and how low that rate's going to go. Kind of on the international side, one of the big things that we're going to see is some sort of reduced tax or tax holiday for cash that's repatriated back to the U.S. So while it's likely that the overall tax rate on future repatriations will be lower, both through the reduced tax rate as well as a movement to a more territorial system, this one-time holiday or reduction in tax may provide some further incentives to bring cash back to the U.S. At this time, we only have a very high-level outline of what these rules will look like, so we'll need to wait and see as to whether or not there are any, we'll call kind of strings attached to the repatriation rules, like we saw about 10 years ago with the Section 965 rules, where there had to be, earmarked investments in the U.S. In order to sustain the lower tax rate on repatriation. I don't know, Bill or Ken, if you have any other thoughts on the potential corporate tax changes, especially on the international side.
Hi, Roy. This is Ken. Sorry, go ahead, Bill.
I was going to say, I think it's pretty wide open, and I just keep track of Twitter to see what the breaking news is.
I'd have to bet there's going to be a son of 965 at least. That seems to be something all the Republicans can agree on, bringing back cash to the U.S. The interesting thing is just from a fiscal perspective, I think most people want a lower U.S. corporate tax rate. If the rate goes down to 15 or 20 and we don't have other sources of revenue like a VAT, it'll result in fiscal deficits. If and when the Democrats ever come back, whatever low tax rate exists for a period of time may very well be unwound. And I think we sort of had a bit of a consensus between the parties over the last 20 or 30 years, sort of a balance of terror after the 1986 Tax Reform Act. Now I think everything is on the table, and it's probably going to swing wildly over the next 10 years or so. It could go in both directions at periodic time. So nothing's permanent, I guess, is the way I would look at it.
All right, thanks everyone. So we got to get this last polling question in. Where do you think that your company may be vulnerable on audit or due diligence? Roy went through these various areas: transfer pricing, debt equity, CE, U.S. tax reporting, VAT, or employment mobility. So remember to answer it and click the submit. And keep on getting some questions in. If we don't get to your question, which we won't, we'll follow up with you. But Roy, one came in, and I'm hoping just for a real quick answer. Is there any statute of limitation on these foreign disclosure forms that haven't been filed? So if a company hasn't filed in 10 years, is there any statute of limitation?
Yeah, so that's actually a good point. So yes, if the form's not substantially complete, it's not been considered filed, so the statute of limitations is considered open on that. But there was, as part of the healthcare bill that came through a few years ago, a clarification that it isn't just the statute of limitations with respect to the assessment of penalties for not filing that form, but the statute of limitations on the entire U.S. return is open until those forms are completed. So again, just to reiterate the point that there is the voluntary disclosure process that's available, to be able to use that to not only to clear out anything on a penalty-free basis, but to also fix any statute of limitation issues that may result because forms had not been filed.
Excellent. Great. Thanks, Roy. With that, we're going to wrap up. We are at 11 o'clock on the dot. So thanks, everyone, for attending, and hope to see you next week. With that, Emily, I'll turn it back to you.
Great. Thank you, Rich, and thank you to all of our presenters for a great presentation today. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet in order to receive that credit. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE icon at the bottom of your screen. Open the icon and click the printer in the lower right corner to download a PDF copy now. I'll be keeping the webcast console open for a few minutes to give you time to do this, and a copy of your CPE certificate will be emailed within 2 weeks, should you have any difficulties downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us today, and we hope you'll join us again next week for the 2016 year-end state and local tax update. Thank you.